which remains disrupted with no real end in sight. All actors there talking in different tones and saying different things. 23,600, 630, 640 is where we're at. So basically, we've broken below the this week's low, which was about 23,697 or so. So it's a full 1% gone, straight to the word go. The Nifty Bank is down 1.5%. And this is the newer kind of worry, banks, and which you didn't have to worry about till about 10 days back. But that perception has changed, and maybe there is a perception that there is stress coming here as far as the banking space goes. 54,875 on the Nifty Bank as well. Mid-cap index is down 1. Small-cap index perhaps will come up on your screen. And there as well should be in line with that a third of a percent cut on the small cap index. So what 2:1 declines to advances is what you have so far. So there's a lone stock in the green, and that is Coal India. Everything else is down, and Indigo and ICICI and Eternal, L&T, Kotak, basically 49 down and 1 up. That basically tells you the state of affairs. We're at 23,600, on the verge of breaking 23,600. As of now.
Just a word on Coal India. You said the lone stock in the green is Coal India. And that stock is up by all of 1 rupee. So it's obviously not as big a gain that we're seeing. And now we're seeing some bit of a smidge of a spike in ONGC, which is also higher by about 50 paise. But by and large, a weekday. Rima?
Well, 48 out of the 50 stocks in the red, and deep cuts on Interglobe Aviation. That's the top loser, 3.5% lower, 4,200 on Interglobe Aviation. Then come all the banks. So let's start with ICICI Bank. That's 2.5% down. Kotak Mahindra Bank slides 1.7%. Auto names are not spared. Yesterday, autos were the biggest drags. M&M, Tata Motors, passenger vehicles, Eicher Motors. Across the board, you are seeing cuts. Bajaj Auto, where there is fear about the auto rickshaw sales in the state of Maharashtra as new permits have been halted or paused for now. Bajaj Auto continues to slide lower this week. Bajaj Auto is down nearly 6-7%. Eternal has been the weakest link in the market from the start of the year, now 22% lower from the beginning of 2026. So Eternal continues to see pressure. Induction, stuff tops have been completely sold out on all the on Amazon, Blinkit, Big Basket, etc. L&T has been under pressure. L&T is lower by 2.5% today. I think there's no place to hide. Shriram Finance has been weak. You've got even PSU banks like State Bank of India. Trent is down 1.5%. Pull up a Bharti Airtel, where Jefferies is highlighting the possibility of tariff hikes gets pushed further down the road, may not happen in June as per their earlier expectation. So that's under pressure. Reliance Industries, 0.5% lower. IT is in the red, but not falling as much. You've got an HCL Tech Mahindra in the green, but you've got mild downticks of about 0.5 to 1% on the other large cap IT names. Infosys, TCS down close to about 0.8%. And now it's only Coal India, which is flat, not even in the green.
Not even in the green. The only places to hide right now in the mid-cap end of things are Adani Total Gas. Yesterday was a big surge that we saw in the stock, up almost 20%, and right now, straight off the bat, it's up 13%, taking the last 2-3 sessions gains to over 30% on that stock. So Adani Total Gas is the one which is actually, catching everyone by surprise on the way up. The other group of stocks are the induction cooktop stocks. So you have TTK Prestige, another 13% higher today. Stovecraft is another 9% higher today. Butterfly, Gandhimati, the one that we spoke about earlier as well, up 7%. So all these stocks this week itself up anywhere between 25 to 30%. HOEC has an element of upstream, has both oil and gas. That stock is up around 6% as well. Bajaj Electricals also has some bit of electrical appliances out there. So that stock higher as we speak too. Bajaj Electricals is the one that I'm talking about. But on the obverse side, we have a lot of stocks which are declining. So Astral down 6%, Borosil down 5%. Pipes, the ones that did well yesterday are selling off as well. WeWork is the other one which is lower. Aether India, the chemical stock, down around 4% too. Then you have HPCL, Mahanagar Gas, IOC, PG Electroplast, Jubilant Foodworks, Dixon Tech, you name it, it's all lower. And as we speak, the mid-cap index down nearly 1,000 points, and the Nifty Bank swiftly getting there as well. Broken below the 55,000 mark, now on the verge of breaking 54,800, down 920 points for the Nifty Bank, and the Nifty is down all of 300 points at the open itself, well below the 23,600 mark as well, and good 100, 200 points below the Monday low that we hit of 23,700 thereabouts.
Yeah, absolutely. Let's we'll of course look at prices and how they move, but they're all down for now. So 23,565 with very little exception as of now. Sridhar Sivaram is with us. He's investment director at Enam Holdings. Sridhar, good morning. Great to have you with us. Thanks for joining us. I just want to start with banks, Sridhar. So that's a relatively newer area to see a fair bit of damage, private banks especially. What's the worry? Is it there's a thinking that what's happening in the rest of the economy will show up in banks as well, or this precedes the latest Iran issue? What's the underlying worry?
So actually, I've been having a non-consensus view on private banks for a while now, and I've put out a lot of data on my LinkedIn on why private banks, especially the large ones, have some issues. I think what has happened is, if you take the last 12 months or even 18 months, PSU banks have become very aggressive on the retail space, which has been like the bastion for private banks. Last quarter numbers were a bit staggering, that the PSU banks, if you take the top 6 PSU banks leaving SBI, their loan growth, the retail loan growth was almost 23%. And compare that with the top 3 private banks with roughly similar assets, which is 60 lakh crores for these 6 PSU banks, and top 3 private banks also roughly loan book is 60 lakh crores, the overall loan book. Their retail loan book grown single digits. Mortgages for the PSUs were about 17-18% growth, and this is about 6-7%. Vehicle was even more shocking, almost 20% for the PSUs, and it was single digit for almost 1 or 2% for the private banks. And what has happened is that you're seeing full page ads from PSU banks, home loans at 725, vehicle loans at 775, 8, which we have never seen. The earlier view was stray loans people will take, but on size, nobody goes to take an auto loan from a PSU bank. That has flipped. So when I speak to the PSU banks and I question the profitability model for them, their point is, my guidance is 275 to 3% NIM, 1% ROA. I'm able to reach with this. A 1% ROA for a private bank is a no-no, right? So basically, in our view, the profit pool for the banking sector has shrunk, because the same technology that earlier was something unique to the private sector banks. Now, most PSU banks have invested in technology. The CIBIL score is common for everybody. And they use all the other tech. If you speak to SBI, they'll tell you what all technology measures they use. So I think that's what has happened. The profit pool for the banks are shrinking. It is difficult for them to then move out of such a large segment and find newer segments. So if you see the loan growth of private sector banks, the larger ones, they were disappointing. So I think that is the issue that we are facing, that will they be able to... Heydays, private sector banks used to give you 20% profit growth. We are now in the 10% profit growth band.
But so just to complete that, and that's, I think, beautifully explained, the entire thesis. And you're absolutely right, and you got it. You were early on this one, and the market, of course, is now reacting. So it's a profit pool question.
Yes.
It's not a asset quality issue.
It's not an asset quality issue. Yeah, it's not. It's just a question of reset. That what is the profit pool for the banks? The earlier thesis was private sector banks keep chipping away, taking market share from PSU banks. That has flipped. So it's now the PSU banks bouncing back, taking market share from the private sector banks, and that too from a pool which was very profitable for the private sector banks, because they were making very strong ROAs on this. They're literally vacating a mortgage space, a vehicle loan space, because they think there isn't enough profit. But the PSU banks are happy because their ask is much lower.
Right.
They're
so classic, your margin is my opportunity sort of question.
Exactly.
But, you know, I take your point completely, but all of that perhaps is, how much of that is in the price? The reason why I ask this, and you know, the director will pull up both the Nifty PSU bank and the private bank index over the last 1 year or so. It's not that HDFC Bank has done much in terms of returns over the last couple of years. Neither has ICICI Bank, or, you know, even if you look at Kotak Mahindra Bank as well. The last 1 year, the PSU bank index is up 51%. In you know, the comparison with that, the private bank index is up just 9%. So it's already seen a near 4 times outperformance. So it's I mean, the thesis, while intact, it's also showing up in the price. How much more from here on?
So, large part of the selling in the private banks is coming from FIIs. And when I speak to my, friends in New York or in Hong Kong who run large FII funds, the point they're making is that exactly this, that why would I want to invest in a private bank which is giving me a 10% profit growth with a 2.5 price to book? I'm getting similar growth banks in XYZ region at half the multiple. So that is the question here, that if you're going to grow at 10%, is a 2.5% price to book multiple justified? I'm not here to justify any of this. I have a view, and in fact, within our firm, people have differing views. So what I'm saying is all my views. This is my view, that, I don't think it makes sense. I've seen these banks grow at much faster rate. There is something structural that is happening. These banks have to change their business model a bit, maybe lower profitability, and maybe lower price to book multiple, which market's already doing right now. Maybe there's an opportunity, but this is my view. That's how I'm.
I mean, if the thesis is right, the difference in price to book is still quite a bit, right? There is. The difference. If it's got to go that way, there is a long way to go. If that thesis is right, is what I'm saying.
Yeah, but keep in mind that they still make reasonable ROAs despite all this. So your lower growth is because you're trying to protect your ROA. So for the ROA, maybe there's a case. So many of these private sector banks, if you take the last 5-year performance, have not been that spectacular. They either have been just in line with the market or in some cases even below. What if this were to extend to another 3 years? That is a question people are asking, that if they are going to give suboptimal returns in terms of market returns, then should I stay invested in this or should I look for other opportunities? My personal view is that they will give suboptimal returns. So it's not like they're going to collapse, but you can use them as a funding source. If you find better opportunities somewhere else, use them to fund your opportunities.
Do you have a view that if private banks continue to grow at 10%, what is the appropriate price to book multiple? Your own view.
So it becomes very bank specific, right? So every bank, a smaller bank can possibly grow slightly faster. If you're very large, it is difficult. But SBI has shown that despite being large, is growing faster. So I think it is very stock specific. I will not be able to give an exact answer what should be the price to book multiple. But if your growth is in the 10-12% range, then it seems like these price to book multiples, in my view, look slightly more expensive. Yeah.
Let's talk about the markets then. If you look at the price action, Sridhar, it just seems that now maybe the markets are realizing that this is going to be a prolonged conflict. It's not going to be a quick couple of days, Trump declares victory, etc. Have you all started talking about the worst case scenario?
See, honestly, we are not geopolitical experts. None of us are.
But you look at the tape, you look at the ticker every day, and you'll have views on this.
We were not trade experts. We have to now suddenly look at a lot of things. But my own personal view is that this drags longer than what most experts are anticipating. And it has a lot of cascading effect. We are just looking at crude and oil, but it just extends a lot because the fact that crude or LPG or LNG disruption has impact in, say, mining because of sulfur, it has impact in plastics, it has impacts in refinery, it has so many impacts. It's very difficult for us to, literally go and figure out what exactly will be the impact. We were expecting that we'll get about 15% earnings growth for the market next year. We think at least maybe 3 to 4% percentage points will reduce from there.
Wow.
So
at this juncture, with 2 weeks of war in, or if this prolongs, then 3 to 4%?
Yeah, at this juncture, because 2 weeks of war is not just 2 weeks.
Yeah.
To get restoration of normalcy is another month.
Right.
So you're talking of already, almost 45 days of disruption. So that impacts your first quarter already. So we think that this can impact by about 300 to 400 basis points of earnings for next year, provided everything comes back to normalcy in that period.
Where are then the opportunities? Because, I'm just going sector by sector. Banks, you've said, there is that private sector versus public sector bank sort of problem here. IT has its own AI-related challenges. Then you have FMCG, where obviously growth isn't coming by. And if you think banks should not be trading at the multiples that they are for the growth that they're showing, then FMCG is a different can of worms out there. A lot of the new age companies which are growing extremely fast are trading at near triple-digit price to earnings as well. Where do you find opportunity?
This is exactly the conversation I'm having with somebody, my ex-colleague in New York.
Okay.
That why should I invest in India on the large cap? I'm not saying that this was the answer, but obviously there are stock-specific opportunities. Keep in mind that Asia is going through an earnings super cycle as we speak. So I'm removing the war-related issues.
Yes.
Korea will grow at 100% earnings this year. Taiwan
is up 3x already.
Yeah. Despite all the volatility,
still, I think at 10 times earnings, huh?
Yeah, it's at 10 times earnings. Korea is already up 30% year to date, despite all the volatility. It was down 15% one day. You can just adjust all that. Taiwan earnings are growing between 25 and 30%. Even China earnings are growing between 15 and 18. This is pre-war. Obviously, you will have to adjust some of it, and they are all at substantial discounts to India. So when fund managers tell me that FIs are selling, they're making a mistake, they'll have to come back and buy at a higher price. I mean, you have to be an asset allocator sitting in New York or Singapore to understand what they're doing. I mean, this is not the only market. So there are other markets available. Having said that, these are cycles. I've seen many cycles. Those earnings are cyclical. They will turn. Our earnings are low. They will also turn. So there are opportunities in the market. So I'm not painting a doomsday scenario. I'm just saying these are cycles, and we live through these cycles. We find opportunities. So maybe there aren't enough opportunities in the large cap space as we speak. Maybe pharma is a large space where we find a lot of opportunities. As we come down the large cap, there are enough and more opportunities. And as you know, that mid and small caps have literally got decimated. We don't invest so much in the small, but in the mid cap space, which is slightly larger, there is enough and more opportunities, which is more stock specific. That's the point I'm making, that it may not be sector. Yeah, so you can say power sector, there are opportunities because you need the power demand is constantly going to be there. There are manufacturing opportunities which are coming up because of China +1, some opportunities in the chemical space. When you dig down deep, there are enough opportunities. But for somebody sitting in New York or Hong Kong, when you're looking at top down, in heydays, it used to be just buy IT, buy financials, buy some infrastructure, and then you're done, and everything moves up. That has changed. That's the point I'm making.
You can, but in the broader space, Sridhar, you're still saying that you can make a reasonably 15, 20 stock portfolios, choosing single stocks. I mean, if you were starting a small cap fund or a small and mid cap fund,
you can easily make. As I said, I may not be bullish on, say, large private sector banks, but there could be opportunities in slightly niche banks or NBFCs. So it's not like everything is in danger zone. Some have their own challenges, and the market has to adjust to those challenges. If it is already priced in, if they're priced in for a 10% growth, I mean, like in heydays, we used to be bullish on PSU banks, not because they were growing at 20%. They were growing at 10%, but the market has mispriced it. So there are a lot of mispricing in the market, which may not be there in the large cap space, because you also know that in the large cap space, there's so much of money coming in. On a one-year basis, Nifty is still up. So we are talking of doomsday today, but the Nifty is still up on a one-year basis.
Yeah.
So that's the point I'm making, that the opportunity seems to be below the Nifty.
And from the highs, I think today we might have hit the 10% mark as of today. Well, I think wonderful interview, very sort of wholesome, I should say, and you explained it very well, the private sector bank thesis, and we'll see what happens, but always a pleasure speaking with you.
Thank you.
Appreciate it. Thank you very much.
All right, let's move on now. Sandeep Poundrik, Secretary of Ministry of Steel, is now joining in, and the conversation with him will focus on 3 points. One, of course, West Asia war-led disruption. This point number 2 is CBAM and decarbonization challenge, and the way forward for NMDC Steel and RINL. Thank you very much, sir, for joining in. This is Rima here. So top of mind for everyone today is the Iran war. It's disrupting supply chains, it's driving up input prices, curtailing gas and other supplies. How is the government looking to mitigate these issues, given that gas is critical for secondary steel producers, coking coal, etc.? And what have the companies themselves also told you?
Thank you. Good morning. Basically speaking, as you said, that like any other industrial sector, steel sector is also impacted by the present situation. There are 3 or 4 things which are basically impacting the steel sector. First, obviously, is the propane. Now, most of the steel industry, especially the ISPs, use propane for different units. And the scarcity of propane may affect their operations. The second is natural gas. Many industries use natural gas. Third is LPG, especially for small steel producers, because many of them use LPG for industrial use. And the last is, to some extent, limestone, a large quantity of which is imported from Middle East, especially UAE and Oman. Now, you asked how are we looking at it. So it's a issue. Companies and steel sector is trying to find solutions or alternatives. So, for example, limestone, if I take, they are trying to see that whether they can source it domestically from Rajasthan or other industries, other mines. As far as propane is concerned, there are not many alternatives, so they are trying to use it optimally to the extent possible. Natural gas, again, they can use some alternatives, but not much. So this is a real problem for steel sector, and as far as government is concerned, we are trying to see that they are provided what is possible within the circumstances. And we are also talking with the steel sector that they are able to take alternative solutions to the extent possible. We have held consultations with steel sector to see what is the extent of the problem. And
Mr.
we are
Pondrik,
in consultation with MOP&G. We are trying to find.
What is the good morning, sir, Prashant here. What is the cut right now that we've seen coming through for the steel sector?
So till now, I would not say there is cut. Like you know that most of the steel plants have supplies. So if I take about sale, talk about sale, they have about 20-25 days of supplies of propane with them. Similarly, for limestone, they have supplies. So it's not as if the production is being cut today. But if the problem continues, then raw material supply or gas and propane supply may become a problem in coming days. So to date, as per our available information and as per what we have held consultations with the industry, today there is no production cut. All steel plants are running full ISPs. There may be some problem with the small steel producers who are dependent on LPG. That we are looking into.
Would, I mean, just to take that example of sale, Mr. Pondrik, would they calibrate production? Because you said they have propane for 20-25 days. So in that sense, they will in turn, decide who to sell steel. I mean, essentially decide the order of priority, like the government decided the order of priority for gas. Go on.
So, as I said, as of today, they are not looking at scaling down the production, at least for a few days. The production of ISPs is going full throttle. But if the problem continues, then they will have to see how to calibrate the production. Because, as I said, propane is a vital input for them.
Club that, Mr. Pondrik, with what's taking place in China as well, right? If you look at China, in Jan-Feb, their steel exports declined by about 8%. Now, with us having to face a possible production calibration, not immediately, but maybe if it prolongs, then do you think the risk of China dumping their steel into India is real? And what protection measures are we taking for that?
If we look at this year's numbers till now, from April to February, our overall imports have in fact gone down by about 37% as compared to same period for the last year. So imports have significantly gone down especially after the safeguard duty imposed by the government. I don't see in the short term any impact of imports, because even today our domestic production capabilities are more than the consumption. So our consumption has increased this year by about 7.2% from April to February, while our production has increased, finished steel production has increased by 10.2%. So our production capabilities are there domestically. If this problem continues for a long time, then we will have to see how the consumption and production are matched. But then I would presume that if this continues for a long time, it will also have impact on the consumption, not only on production.
Right.
So there's an impact for both.
And were that to happen, would you consider then any sort of additional protection measures for the industry, if that was to happen, hypothetically?
I can't comment on that now. That's something in the future. For now, we are going with the present safeguard duty and other measures.
So you said some small steel producers have been impacted. Could you give us an indication to what extent, how many have shut shop or have been impacted? And then I'll come to the next question. Yeah.
So we don't have the exact numbers now, but we have received representations from associations of small steel producers saying that they are feeling scarcity of LPG. So I can't really give you any clear number or a proportion, but they are anticipating problems because of shortage of LPG. That's what they have communicated to us. We are just still holding consultations and looking at the problem.
So one issue you said is the supply of propane natural gas. For now, it's okay. We've got about 20-25 days of supply. But the other is also the price. To what extent are steel producers feeling a surge in the overall raw material basket for them? To what extent has been the inflationary cost of this?
So as far as propane is concerned, and I am talking only about SAIL right now, I don't have the numbers for other ISPs about the raw material supplies they have right now. But the price of propane has not increased because that is domestically produced. It's only could impact because the oil companies or refineries will produce more LPGs. It's not as if propane is coming from outside. Natural gas, on the other hand, may have impact on price because it's imported to a large extent. So we will have to see how, but I don't see that as a major cost implication for steel, because while these inputs are important, they are not a large chunk of the price basket. So they are very small as in terms of cost of production. So that should not be a major problem. More important is the supply assurance.
Mr. Pondrik, in terms of end product, right, it impacts, this shortage disruption impacts all end products equally, or specialized steel more, or, if you were to sort of look at this from that angle, could you clarify? Yeah. So basically, see, if you see propane is majorly used for cutting off slabs in the continuous casters. So that's a general, means it impacts almost all mills where it is being done. So that's a general product. I don't see this propane to be sort of product specific unless it is being used somewhere in a special mill. On the other hand, the natural gas is being used by some mills, not by all mills. So that will have impact on it will have partial impact on mills and producers who are using natural gas. So, for example, SAIL doesn't use natural gas, but many private producers use natural gas. So it will have different impact on different producers. And as I said, limestone should not be a problem because we have domestic supply. So but I don't see too much variation as a specialty steel or steel. It will have a general impact on the sector if it continues for
foreseeable future.
So this time, in terms of timeline, in your assessment, internal ministry timeline, you earlier said if it continues for a few more days, maybe they will have to think about calibration. So I mean, obviously it's all fluid and dynamic, right?
Yeah, as I said, SAIL has 20-25 of days of supplies. Others also have supplies. So let us wait. Means maybe if things continue for 2 more weeks, then we will have to see how to proceed. But for now, things are under control.
What about coking coal availability right now? How important would that be to the value chain? Because that is nearly all of that is imported.
Yeah, but that's correct. But then coking coal mostly comes, roughly 60% comes from Australia. So that's not a problem for now. About 30% comes from USA and Russia. So that's again not a major impact for now. And we also have domestic coking coal availability, though it is only about 10%. Again, almost all steel plants have enough coking coal supplies. Every plant has roughly a month of supply with them, always, normally. So, coking coal, I don't see any problem for now.
So, one final question then on Europe. Because Europe accounts for, I think, close to about half of India's steel exports, and Europe imposed those CBAM, Carbon Market Adjustment Mechanism, from 1st of January, via which there is a tax on exports from India, 25 to 30%. Has there been a loss in sales to Europe? If yes, on account of that? And 2, is the government looking to take steps to address that?
So, I will take it means first about the exports. So, if you actually see the numbers, this year our exports have increased by roughly 36% as compared to last year. So, there has been increase in exports, and most of our exports go to Europe. As you know, a significant portion goes to Europe. Now, in terms of impact of CBAM, yes, it will have an impact. But if you see the numbers, means for first 2 months since January and February, there has not been much impact, but it will have an impact means the CBAM will have an impact. Now, you said, what are we trying to do about it? So, as you know, there are discussions going on on the CBAM issue with European Union. We are trying to find out a solution. What our stand is that whatever carbon tax or indirect carbon tax is being paid by the producers in India should be taken into account when that is calculated for export of steel to Europe. That is a technical discussion still going on, and we will have to see how, means what decision is taken on that.
Yeah. Mr. Poundrik, I just briefly on LPG, sir, which is where the situation, I guess, is the most delicate. What's the, it's so obviously a topic of conversation, discussion, deliberation within the government. Where are we at, sir? I mean, that of course also is what is the public is most in that sense concerned about, right? So just your thoughts.
I don't think I am the right person to answer that question about availability of LPG. I can only talk about steel sector. As I said, to some extent, small steel producers are impacted.
Okay.
ISPs don't use much of LPG.
Yeah. Okay, fair enough. My question was obviously slightly broader, but I understand. And thank you very much for coming on. Clarifies a great deal, and thank you for joining us here on CNBC TV18. We'll take a quick commercial break here. We will, of course, focus on exactly that, the energy shortage, the shortage which will emerge, as Mr. Poundrik also said, if this goes on for the foreseeable future. We'll be joined by M.K. Surana, former CMD of HPCL, and Sandeep Kumar Gupta, former CMD of GAIL, to talk about these disruptions. Stay tuned.
Welcome back. Still down about 1% on the index, but we've managed to recover from a low of 23,556. So from that level, there has been a recovery of close to about 75 odd points. But let's turn our attention now to commodities. Manisha is joining in with more on crude. Manisha.
Well, thank you so much for that. It continues to be very, very volatile each day when we are looking at $10 to $12 of a move coming in on every single day. It has been between 10 to 15% of a move as well as that we've seen in the last couple of sessions as well. And today is no different, where you are looking at nearly 9% of gains. We are back above $100 a barrel, and this is after 82 of a low that we saw just a couple of days ago. Well, gasoline also is trading at a 4-year highs. You have heating oil prices, which are up 6% in the Asian markets right now, and that also is at 3.5-year highs into the markets there. Supply disruptions caused by Iran war is one of the major reasons that we've seen markets continue to react in this way. And then Iran conflict has entered day 13, and the Gulf producers have cut output anywhere between 6 to 12% as per whatever report that you're reading there. It also has to do with the reports about 2 international tankers being attacked in Iraq waters. That has led to premium coming back in case of prices there. And Iran conflict, remember, has just about continued, even despite claims from US that war is close to an end. Take a look at the IEA numbers and the reaction of that into the market. So IEA, after that discussion in last 3 or 4 sessions, has finally approved largest ever release of reserves at around 400 million barrels. This is double of what we saw in 2022 at 182 million barrels therein. Now, IEA members hold emergency stockpiles of around 1.2 billion barrels. And in addition to that, there is 600 million barrels, which that is held as an industry stock under government obligations as per 90 days of holdings therein. So what the markets really are looking at is US releasing 172 million barrels out of this 400, and Japan is wanting to pitch in with 80 million barrels as well. Interestingly, the street believes that 400 million barrels is something that the markets have already digested and factored in. And also the fact that this is going to be a one-time release with the kind of holdings that IEA and the G7 countries have, they may not be able to do something like this yet again. Apart from that, it is also about the crude availability to refiners, which would be at various destinations. So as early as next week is when we will see Japan start to release these stocks. The other IEA or the G7 countries, what is the timeline, what areas, what destinations, is still not clear. Apart from that, this is about crude oil. The issues of the gas shortages are not resolved, and that seems to be weaving its way into the markets as well. Apart from that, Canada, which is also part of G7 and within the IEA as well, says that they are already at record high levels of oil and natural gas output and exports, and they will not be able to add anything more. Canada, a regulator in Sense of Energy, also says that Canada has minimal short-term ability to further increase production. So that member and various other members like that are perhaps out. Interestingly, when you look at the crude oil price forecast going ahead, the first week of January, most of the markets believe that we are going to a surplus area, and you could be looking at bearish crude oil prices. But some of the banks and brokerages are actually now talking about a deficit in the first and the second quarter as well. Take a look at Bank of America report that came in last evening, which says that the second quarter average for crude could be at $80 a barrel, but prices could surge to $100 or even $130 a barrel in case of a severe scenario going forward. A report from JP Morgan Chase also says that the Brent could see $120 a barrel on strained or suspended disruption in case of a Strait of Hormuz that we already are dealing with. Citi also says that the Brent will continue to trade between that $80 to $90 a barrel range for the next 1 to 2 weeks. Nobody clearly is giving you a long-term sense right now, because once we see what the next 2 weeks bring in is where we will see more reactions coming in. But there also is a report from Barclays which says that they have various scenarios in the markets right now, but there's a 10% scenario which implies that the Brent could go to $150 a barrel before the end of the month of March itself. So it's all over the place right now, with most of the banks and brokerages suggesting that we are in for higher crude prices.
Absolutely. Thanks very much for that, Manisha. So important details. Well, let's talk about the energy security and potential energy shortages. Mr. M.K. Surana is former CMD of HPCL, and we have Sandeep Kumar Gupta, former CMD of GAIL, now joining in. So thanks very much, both of you, for joining us. You know, Mr. Gupta, you would, of course, when you joined earlier this week, you were absolutely prescient when you said that the situation is delicate for LPG. I think this was Tuesday morning. And since then, I think we've heard the government come in, talk about that particular issue. We've heard it from, specific ministries. We've had this priority of gas allocation, etc., which has been put out. If I can start with you, Mr. Gupta, where are we at now with regards to LPG?
Yeah, good morning, Prashant, and good morning, your colleagues also. Good morning, viewers. Good morning, Suranaji. Thank you for bringing me here again. At the start of this war, the oil companies had estimated that they have about 3 to 4 weeks of supplies of LPG available with them. And I believe they must have factored in all that is filled in tanks, in cylinders, what is in transit beyond the Strait of Hormuz, etc. So even if we consider that it is on an average, say about 25 days on an average basis, from that level, actually some supplies to industries and commercial establishments has been rationed or cut. So that provides additional cushion for domestic consumers, definitely. As I said, about 13% of the consumption goes to C&I, 9% to commercial, and about 3 to 4% in industrial. So a rationing of that supplies to C&I segment provides additional comfort to domestic consumers. Besides that, the government has mandated 25% increase in production from refineries. So presently, the yield on an average basis is about 4% of the crude processed. So 25% increase from that level will provide additional cushion. So in my estimate, I've done a back of envelope calculation. I think up to 31 days a month, there should not be any problem. So I think by end of this month, there should not be any problem for domestic consumers. Yes, we have to see what is the decision of the committee which has been constituted by the OMCs, 3 OMCs, about the supplies to commercial and industrial establishments. But I think for the general public, for the households, there is no reason to panic. And I believe they are comfortable for next 10 to 15 days, definitely. And beyond that, we will have to see, we will have to review the situation.
Right. Yeah, so that's very, very helpful. But because you're saying that till the end of the month, right, 31 days, but that is basically from the start of the war, because we're already 10 days in, 11, 12 days in.
Yes.
So there should be no problem in LPG availability till the end of this month.
And fresh cargoes have also been sourced. So at least 2 cargoes yesterday, the Joint Secretary from Ministry of Petroleum mentioned that 2 cargoes are on the way. And I'm very sure that there is no dearth of LPG worldwide, and more cargoes will be sourced shortly, which will further shore up the stocks in India.
But I can tell you, I mean, and you did say no reason for households to panic, people to panic on LPG. And I think that should come as a reassurance, because you must have seen, right, the sales of induction cookers, etc., through the roof. And people, of course, anticipating and preparing for what can happen if this continues for an indefinite period of time. Mr. Surana, your own thoughts, sir. As Mr. Gupta said, I mean, some of the from the refinery output side as well, there perhaps will be more diversion towards this. But you heard, Mr. Gupta, your own assessment of the situation?
Yeah, good morning, Prashant and Gupta ji and all viewers. I fully agree with what Mr. Sandeep Gupta is saying about the situation. But I also want to add one thing, that what you are seeing the queuing today is basically not purely because of the shortage, but it is also because of the psychology which works on the people. And we have seen it happening in the past also. Whenever the people think that there are going to be shortage, people start keeping the second cylinder full, people start hoarding, even some nearby cylinders are available, they will try to take that. And especially the industrial, the hoteliers, the restaurant people, they also try to garner some of the domestic cylinders in the process. Otherwise, nothing would happen in 2 days, which will make all of a sudden a shortage. So the queues which you are seeing right now is more because of the panic which has got created. And maybe in today's digital world, the things work whole 24/7 and the negative news run faster. So the fun part is that the long queues, etc., which you are seeing may not be purely because all households are having a shortage of the LPG. That's number one. So this rush goes on for 2, 3, 4 days in the initial stage, and then it subsides. The second thing is availability. Of course, the situation is unprecedented, so it is not a business as usual. But the LPG as such is available in the world, so it is only to get it because you might be having the sources which were more near to you, and now you have to get from further distances. So it may take time, but you have got the LPG from US, from Australia, from Canada, and you can source it. So you have to manage the intermediate time. And In that process, government has taken some proactive actions like repurposing or giving prioritizing to domestic sector compared to the industrial sector, and diverting whole of the propane and butane and C3, C4 components purely for the LPG purposes. So you may you will hear the noises from the industrial customers and the commercial customers in between. But these are the situations which we need to deal. And I think government has taken what are the actions are required to be taken. And I can tell you, being in the part of the industry, that the topmost priority on the oil marketing companies and the government, which remains, is the ensuring the supply. Everything else comes subservient to that. So I'm sure that the people are working overtime to ensure that. And but one thing which we need to be guarding always, that it cannot go on forever, which I have been mentioning since last week, that the intermediate measures can give you a reprieve to tide over the situation, but it cannot solve the problem forever. And more you go continue with these constraints, more and more problem will you have, and at an escalating mechanism. So while I'm sure that the government is doing, and yesterday Joint Secretary has mentioned all the measures which they have taken, so people need not panic. And in the past also, we have always ensured, whether it is flood or famine or lockout or riots or anything, the domestic cooking gas was provided. And I'm sure that it will be done this time.
You know, just to complete that point, and as our colleagues are pointing out, Mr. Surana or Mr. Gupta, if you want to come in, the problem also, there is, of course, I mean, if this goes on for the foreseeable future, there perhaps is an actual problem. But the problem also is that the booking system for LPG seems to be not working as well. So while dealers are saying that we have supply, but we can't give it out as the system is down, the tech is not working. I mean, that's something that's some feedback that we've got from across the board when we've done channel checks. Mr. Surana, you want to take that?
No, there may be two components to it, because government has said that there will be a cooling time of 25 days between the two booking cylinder, and people may not be aware of it. So even if the people who have booked the cylinder just less than 25 days, they are trying to book it again, it must be blocking. That may be one part of it. The second part of it is too many people rushing in to book it together. There may be some issue. But that part, technical problem can be looked at by the industry. And the third part is just to create a panic. The miscreants will try to ensure to see that the system doesn't work, so the black marketing happens. So we need to take care of all the three things.
Mr. Gupta, very quickly, you were there in, I think, IOC, when in 2022, when the IEA decided to release strategic reserves to the tune of 182 million. Now, once again, they're planning to do that, 400 million. India is not participating this time, the last time they had. To what extent do you think, and how will it benefit India and the shortages that we are seeing? What are your thoughts?
No, the question is that release of barrels in the market will definitely bring that much supply. So let's say 20 million barrels were not coming from Hormuz for almost 13 days now. So 400 million is equivalent to 20 days of supplies from that. So it definitely cools off the market. Is it a solution forever? Answer is definitely no. But it definitely gives a reprieve. And the country like India may not be participating in it, but the oil is a world commodity, international commodity. So if the oil barrels are available in the market, it does help, because wherever it goes, the remaining barrels will come to us. So it does help. Now, the question is that whether it will happen immediately, it will take some time, because the mechanism of it is that these are held by the countries concerned and their governments, and they have to have the mechanism to release from various places. There may be some issues related to infrastructure to release that all of a sudden, and where it gets reached. But definitely it will help. There is no doubt about it. But this is one-time solution. Then we have to hope that within the next 1 week we have a solution to the problem.
Oil itself, crude oil, sorry, Mr. Gupta, go on, please.
Yeah, Prashant, I would like to supplement.
Yes.
The East-West pipeline of Saudi Arabia, which leads crude oil to Yanbu port in the Red Sea, that can also provide additional 5 million barrels per day to the world. And on the top of it, this 400 million barrels. So put together, I think this is about a month's supply to the world, which has been ensured. So definitely this will have an effect on cooling of the prices, and also while India may not get, but India will be getting the rest of the crude which is available in the world. So definitely every country will be benefited by these moves.
Yeah, absolutely.
In fact, Saudi had started that Yanbu pipeline, and I understand that some cargoes are coming from the Red Sea on that.
Okay.
And also some of the cargoes can start from Fujairah of UAE, which is down the straits, and So that gives a reprieve of around 6.5 to 7 million barrels a day.
But this, Mr. Gupta, have you heard of Mr. Surana about, there were some reports of Iran hitting commercial ships, etc. But there were some reports that ship Bangladeshi cargo, etc., is passing through. I mean, have you heard whether we are able to strike an agreement with Iran for safe passage, or not really? Any of you?
I do not have any idea about it.
Mr. Surana?
No, there will be some back channels work must be going on, but I don't think that we should be discussing those part of the things here, because if something works out, it is good for the country, but it will always have some diplomatic connotations.
Yeah. Mr. Gupta, you gave us the estimation on LPG. Do you have a similar estimation for natural gas, sir?
Natural gas, I mentioned earlier also that the natural gas position is not that critical, considering that almost only 60 million standard cubic meters per day passes through Strait of Hormuz, which can be managed through cuts on non-essential sectors. And thereafter, on 9th of March, there has been a natural gas supply regulation order from the government, which has rationed the natural gas supplies to industries and various consumption centers. So while there is 100% priority to the domestic consumption, but for fertilizers have been restricted to 70%, and the C&I segment of CGDs and the industries supplied by the pipeline operators directly or the marketers directly is also restricted to 80% level. So with these measures, I am very sure that on natural gas front, there is not going to be any problem for quite some time.
Got it. Thank you very much. We'll leave it there, gentlemen, and thank you for joining us with your expertise. And we look forward. Yes, Mr. Gupta.
Since there is a panic, I must tell again that on an average, on a country basis, there is a consumption of only 4 cylinders per household on an average basis. Even if we consider liberal users and those who have got large number of family members, even then I do not assume that a cylinder can be consumed more than once in a month. So there should not be any reason for panic. And while ministry has already instituted mechanism that there will not be any booking before 25 days of last supply, I believe the oil company should create that message also whenever the booking is being attempted, so that it does not create a panic situation. But the general public should not panic, and they should also start alternative measures like maybe installing electric stoves or induction cookers, etc. To ease the situation. Yeah.
No, absolutely.
So in that situation, we all must collaborate.
Absolutely, absolutely. Well put, sir. Thank you very much, Mr. Gupta, for joining us. Mr. Surana, really appreciate your time here, and hope we can sort of, come back to you as the situation develops and hopefully improves. Thank you. We'll take a break. We are back with, an eye on the markets, which have recovered, by the way. We are back about 23,600. So that's the focus on the other side.
Welcome back. Let's get in a few technical trading ideas. Chandan Taparia, Motilal Oswal Financial Services is now joining in. Chandan.
Good morning, Rima and Prasant. Thanks for having me. So, talking about Nifty, it has been making lower top, lower bottom on daily and the weekly chart until it holds below 24,000. Bounce could be sold to retest the key support of 23,500 to 23,333. Talking about Bank Nifty index, here also we are making the negative price pattern. It has been making lower top, lower bottom. So till it holds below 55,500, it can go down towards 54,500 marks. So negative bias in both the indices. India VIX is at 22 marks. We have seen a jump of more than 100%. So in this scenario, it would be tough to see the swings and bounce could be sold as of now. Now looking at the trading ideas, first that is buy on Tata Power. In fact, selective power, coal companies are doing well in this scenario. So Tata Power is one of the strongest counter which has given a consolidation breakout on daily and weekly chart with positive price pattern, and put writing is also visible. So one can buy with support of 385 for an upside target towards 415. Second trading idea, that is buy on Coal India, one of the strongest counter with margin of safety. One can buy with support of 440, and this positive price setup can take it towards 465 to 470. Negative bias on Jubilant Food. It has been making lower top, lower bottom. Structure is weak with built up of short position. So one can sell with a stop loss of 470, and this counter can go down towards 435.
Thank you very much for that. Get into a break. On the other side is our special segment, Market Masters. Lata will be joined by Rahul Arora of Ashika Institutional Equity. Stay tuned.
Welcome to Market Masters. We can't steer away from markets, can we? Because today the Nifty has officially entered correction terrain. The index is down 10.5% from its February 1st high of 26,328. So, do we bottom fish on the hope that the war won't be endless? Or should we brace for even bear market terrain, correction leading to bear market terrain? Of course, the rupee is also at a fresh new low. Again, after the Gulf War, we are going to be impacted by AI, and that will be upon us. So what do investors do at this point in time? I have with me someone who routinely answers these questions. I have with me my former favorite colleague and right now CEO of Ashika Institutional Equities, Rahul Arora. Good morning, Rahul. Welcome back.
Thank you for having me on the show, Lata ma'am. It's a pleasure to be back.
Okay, well, we have to discuss serious questions now. Can't indulge in the luxury of nostalgia. Well, at this point in time, would you tell your investors, tell your clients, don't invest at all?
Yeah, I think, Lata, we're not catching a falling knife. I think the one thing people need to understand is why this is happening is Trump did not have the House in his first term. He has the Senate and the House in this term. And the midterms are still a good 9 months away.
Yes.
And our assessment by speaking to people in the United States is that the geopolitical threats are not going to recede because he needs these distractions for reasons well known. And so this is probably going to be a very turbulent year for equity markets. So we were at, I think, Lata, when the year started, people were looking at an earnings revival in FY27. I think that has got overshadowed. Now, the question is, most investors were not expecting 24,000 to break on the Nifty. They thought it would be a range-bound year, 24, 27. Now that has broken. So while we don't look at technicals that closely, but our sense is that if this heads another 500,000 points lower, better prices will be available. Valuations are certainly attractive, Lata, I think, especially in the IT sector, which have come off so dramatically because of the other news points, Anthropic and the likes. But I would not be rushing in to catch a falling knife at this point.
Okay, so I wanted to come to that. You know, it's a falling knife in many areas, but some places may already be attractive. Mm-hmm. And they may get more attractive, but it is still a good place to buy. Are there sectors like that?
Absolutely, Lata. So I think let's start with IT services, right? I think if you look at the cash balances of IT companies in India, they have very high free cash flow and dividend yields. My sense is when you talk about reskilling employees, particularly above the age of 35, 40, it's not easy when you're talking about AI and stuff. So if they reduce their cash balances, which will have a very positive impact on the ROE of the companies, and you actually buy out talent and companies, my sense is that IT could be a very good contra buy. People are not thinking of it in that sense, but I think certain companies, you know, whether it's $100 million or $1 billion, I think Coforge recently made a very large acquisition as well. So I think if you look at TCS, Infosys, the bellwethers, I think most of them are 16 to 18 times, which was 26, 27 times when this started. Even in mid caps, I think if you look, if nothing goes wrong, Coforge Persistent will still grow by 25, 30% on sales, EBITDA and PAT. So I think that could be one contrarian. We're literally sitting at the start of March, Lata, and you're already seeing the heat wave that's there. I think companies like Blue Star, Voltas, obviously the optical valuations are not that cheap at 40 times, but if you do have a situation where these companies can grow north of 20, 25%, which is a very strong possibility, then I think there is a case for some of these valuations to inch up closer to 50 times. Defense, which is probably a no-brainer in the current environment, but even stripping this environment out, the finance minister made her highest allocation to defense in the union budget. It was a 15.5% increase in the defense budget. So I think that looks like an interesting theme. And I would sort of go...
Their valuations are rich.
Absolutely, I think.
HAL, BEL, by their historical standards, they are rich.
Yes, but I think, Lata, the challenge there is that there is a scarcity premium. I think there are only 9 or 10 defense stocks where you can really, like, no disrespect meant to any company, but if you go out of the top 10 defense companies and let's say an ICICI Prudential or SBI wants to build a 500,000 crores position in a defense stock, it's very, very difficult. So they chase those stocks and optically. I take your point. Most of the valuations are 2x the ROE, ROCs. But I think the way we look at it, Lata, is even if there is no incremental order win in the defense stocks right now, the kind of backlog that they have in the order book to bill ratio, they should be able to sustain a 20% growth. And I would be a contra buyer in everything that is going wrong because of what's happening in the world. Consumer discretionary names like aviation, You've had some positive news flow around liquor recently. I think that looks like an interesting space. Beer is anyway consumed in summer. So UB, UNSP could be interesting contra buys. And you do have the release of Dhurandhar 2 that is on the anvil. And there are many other, there is Ramayan and stuff like that, Animal 2. So this could be a good year for the return of PVR Inox, which has been a stock that no one's spoken about. So there are certainly pockets in the market, consumer discretionary, consumer durables, defense, IT, and your favorite sector, Lata. I would be a blind buyer in BFSI. I have the courage to go in and buy today. If your viewers don't, they can wait. But I think if you strip out the subsidiary valuations of most banks, including HDFC, Kotak, etc., they're trading close to 2 times. Of course, with the subsidiaries, there'll be 2.4, 2.6,
I think, over there, the worry is, for instance, HDFC, ICICI, when you speak to fund managers, the problem is that where will foreigners sell? These are the stocks they have. So it's not because the companies are doing badly, but because foreigners have Taiwan and Korea and China to buy. They will have to liquidate Nifty stocks.
The only counter to that, Lata, and that's a point well made and well taken. The only counter to that is if you see the last month's numbers of the scheduled commercial banks, if you look at the non-food credit growth, that's already at 13.5%. It's inching towards 14.5%. These are numbers we've not seen for a very, very long time. So there is genuine growth
December
that is coming
even
out.
15.
Exactly.
Right.
So, when you are in that situation where NIMs probably have bottomed out, I don't think we'll get many more interest rate cuts from here. Asset quality is, and you'd remember the last time we had this, asset quality blowout 15, 20 years back, with some of your younger investors may not have been around at that point. None of those exist. We are talking about, digitization and AI. So cost to income ratios will obviously come down. So I think you are looking at a situation where banks could compound earnings by 15, 18% if credit growth hovers in that 13, 15%. So while I understand selling pressure could be there, but they may be tempted, with the growth rate returning. That are there any other pockets, so to speak, where they can probably liquidate from? Because, I mean, Lata, the valuations are very, very tempting in the BFSI sector right now. And the growth rates become better when you look at the NBFCs, the AU, Avases, and the Aptises of the world. Then you grow at 20% plus. So, of course, their valuations are about 3 times, but still nowhere close to the highs.
There is a bit of an asset quality scare.
Sure.
We heard about the ceramic industry getting hit in Gujarat. You will eventually hear of other victims of shortages, hotels, gig workers. There are pockets which are getting impacted. So, the consumption cycle, which depends on people having jobs, is at the moment in a bit of a jitter. And that's hurting banks in terms of fears of asset quality. It perhaps may not come true. Well, when you spoke about air conditioners, I was thinking of another set of consumer durables, which is the staple conversation we have these days. Induction stoves. So is there a TTK purchase, or is there a Havells buy? Those are the companies that make these. It must not be a big part of their product portfolio. But do you think consumer durables of that nature also make for buys?
No, absolutely. I think it may be transient. It may be a couple of quarters phenomena, because it may then recede once, the LPG gas production numbers come back. But you missed out another very popular name, which is Pigeon, Stovecraft. So I think that's another one that's, predominantly into these kind of businesses. But yeah, I think the one thing that's changed, Lata, for a lot of these consumer durable and electrical companies, if you go back, say, 10, 15 years back, they had one area of specialization. And this holds true for even companies that are in washing machines, AC. Now everyone's entered everyone's territory. They've added capacities, and I think what's the one person who's really benefited, or a couple of people, are the people who are technically doing the conversion work or the white labeling, which is Dixon and Amber. So I think if you look at Dixon Technologies, for example, I don't remember the last time Dixon's valuations were this low for a company that has 30-35% return on equity and capital employed, still 30% growth, and you're getting it at 30-35 times 1 year forward. So to me, that is a screaming buy straight up, maybe followed by a Blue Star. I would look at trading Stovecraft, to your specific question on induction tops and so on and so forth. And I think Havells looks like a good play. I think Lloyd is genuinely turning around. When we've interacted with the management over the last 1 year, there is a certain premium to positioning. I think when we speak to retailers like Chroma and Vijay Sales and the way they're retailing Lloyd, so wherever there is a touch and feel, we do tend to go on the ground and figure it out. We do go to the Chroma next door.
Would you look at asset allocation differently now?
Absolutely.
Do you think debt needs a better look?
Absolutely, Lata. I think this is a year where, let's take a profile of someone like
like me, who's single, not no dependents and no kids, I would still say maybe 50 to 60% in equity. That number may have been closer to 70, 80%, a few months back. I do think there is a genuine case for gold and silver even now. Government securities, fixed deposits. So I think maybe if you have a little more gumption, 60% equity, I'd say 20% gold and silver. That takes you to 80, maybe 15% government securities, FDs, and 5% cash. And if you want to do real estate, Lata, I think commercial real estate, I've been talking to some of my friends, banks are paying very well for ATM. If you have a 300, 500 square foot commercial, I think commercial real estate allocation, if you have that kind of capital, but I think more than sector and stock allocation, you've hit the nail on the head. I think this is going to be a year of asset allocation, and I think the people who go down that route. I mean, look at it, Lata. You're getting the US 10-year at what? 4.2, 4.5, right? And if you look at India, for example, if you have a 12% earnings growth next year, post LTCG, post 3-4% rupee depreciation, post inflation in their home country, you're looking at what? 5.5, 6%. So that's the challenge FIs have in India. For 1.5% delta on the US 10-year, is it worth taking a risk on the Indian market right now? So that's the way I'm looking at it. I'm sure foreign capital will return at some point, but I think we'll probably have to navigate the next 3-4 months, with a little more turbulence is my sense.
Okay. Yes, and that will give you enough time to set up your own team, which I believe is on the anvil.
Yes.
Thank you very much, Rahul, for joining us. And as always, you will go out with flying colours in whatever you undertake. All the very best for your new
Always a pleasure, Lata, ma'am. Thank you so much for having me.
Well, that's one word coming on how you should look at asset allocation as well as allocating within the equity space. I hope you enjoyed that as much as I did, because Rahul is an old friend. Wrap up on Bazaar and Market Masters on that note. Chartbusters coming.